Hello everybody. Today's video is going to be about 6 different kinds of investments and the level of risk for each one. We're going to start with the lowest level of risk, and that would be putting your money in a savings account in a bank. So it's not exactly an investment. It's when we look at the differences between savers and investors, this is a tool for savers. Again, it's low risk. It's at your bank. You have a defined interest rate that you're earning on that, but that is a savings account. Now, a certificate of deposit is similar. It's offered by a bank. It has a set time frame that you are locked in to the certificate of deposit, but because you agree to leave your money in for a set period of time, which could be 6 months, a year, 3 years, 5 years, the bank is going to offer you a higher level of interest than they would on a regular savings account. But again, if you choose to do this, you need to make sure that you're not going to need that money during the time frame, of course, that it's going to be locked in. Now, for the investors, not the savers, stocks are, of course, a very popular investment. And a stock, as we learned in our vocabulary, it is a stock represents a small piece of a company, the issuing company for that particular stock. The risk, I would say, is medium to high. There's a lot of things that go into how a stock is valued by the market, but I think considering that the marketplace fluctuates as well as the economy, as well as the performance of a particular company, there's a lot of variables that go into the risk of investing in stocks. The next investment type is bonds. A bond is a loan made by an investor to a business or a government. The risk is low because the issuer has agreed to pay the investor back with interest. They get their investment back and interest on top of that, based on when the bond is going to mature, if you will. That is if you hang on to the bond the whole time. Bonds may also be traded like stocks are traded in the stock market. Bonds can be traded in the bond market. So there's kind of a couple of different ways that you can get your hands on a bond. You don't have to go directly to an issuer. You could just buy a bond in the bond market. Another type of investment is mutual funds. Now, I used to work for a mutual fund company, so I'm a big fan. A mutual fund is an investment that's ideal, I guess, for anybody, because we don't have to have quite as much money to have a diversified portfolio, because a mutual fund holds a variety of different stocks or bonds or a mixture of both in the portfolio. And the portfolio is just like this fruit basket. It's something that holds the money that's been invested, and then professional portfolio managers decide what they're going to invest that money in. And it'll have an objective so that before you invest in it, you'll know what you're getting yourself into. But the risk is going to be similar to the stock market. For stock mutual funds, a medium to high risk. It's going to be lower for bond mutual funds. But again, it's going, because of the diversification, because it's a mixture, it's going to be lower risk than investing in an individual stock or individual bond. And the last investment I want to talk about is index mutual funds. So it is a mutual fund, like we just defined. It's a portfolio of assets. But what's interesting about this portfolio is that it matches, it's identical to a specific financial market index. So there's the S&P 500, there's the Dow Jones Industrial Averages. There are a variety of different indexes or indices that are in the financial market. And so these mutual fund companies have thought, well, they're just going to invest in everything that's on that, being held in that particular index. So for example, the S&P 500 is 500 different stocks. The S&P 500 index fund is going to invest in just those 500 stocks. Because they're not actively managed by a portfolio manager, the expenses are a little bit lower, and these have been very popular. So again, we've taken a look at 6 different investments, 2 for savers, the savings account and the certificate of deposit. And then in the stock market, we looked at stocks that can be bought from an issuer or be traded in the stock market. We talked about bonds, which can be purchased from an issuer, like a company or a government. They can also be traded in the bond market. And then we talked about 2 different kinds of mutual funds, a regular mutual fund and then the index mutual fund.